Masterclass case study where you'll learn about interesting stocks and how to value them. What's interesting about FGEN is that it trades at one standard deviation below its historical PE and price to book. It's cheap. This is Andrew Stotts of Valuation Master Class. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. FGEN is in the utility sector in the Philippines. It is the Philippines' largest natural gas power producer and leader in renewable energy with a total installed capacity of 3,500 megawatts. So the question is FGEN an overlooked power play that deserves a re-rating? There's three things you need to know about this company. First, resolving gas supply issues ensures longevity. Second, a pioneer in renewable energy should be future-proof. An undemanding valuation could lead to a re-rating. Let's review some key statistics. There's 6 analysts covering the company, and they have a target price of 35 Philippine pesos. That's an upside of 26% and a buy recommendation by consensus. The PE ratio is a very reasonable 7 times and a dividend yield of 2.5%. My value estimate is in fact a little bit higher at 39 pesos, and that's a 40% upside. So I'm more positive than the market on this particular valuation. So let's look at the sales of the company. The breakdown is 58% natural gas, geothermal, wind, solar, also at a pretty high 39%, and hydro is tiny at 2%, and there's others at 1%. Now, the price and volume have turned bearish. The share price is down throughout the past year. The share price fluctuated around 30 Philippine pesos, and recently the 50-day moving average has fallen below the 200-day moving average, suggesting a bearish signal. Now, volume RSI has fallen below the 50% line, hence not providing a support for a turnaround. So what's the story here? Well, number one, resolving gas supply issues ensures longevity. Here you can see a picture of the Malampaya gas field, and natural gas is widely accepted as the transition fuel for the midterm future as far as transition to green energy. FGEN generates 58% of its revenue from gas, so it's well positioned there. The main problem is that the country's only gas field, Malampaya, is about to deplete over the next 3 years, and then they are out of gas. Hence, the market raised huge concerns about the longevity and profitability of FGEN's business to compensate for the lack of gas supply. People were concerned. Now, FGEN substitutes domestic gas with imported LNG. First, let's introduce Tokyo Gas. It's the largest natural gas provider in Japan and holds a 20% stake in the LNG terminal that FGEN develops. FGEN currently is constructing the country's first liquefied natural gas LNG terminal with a capacity of about 5 million metric tons. The terminal allows to store imported LNG and turn it back to gaseous form to generate energy. So it's usually shipped in liquefied natural gas form. So far, the construction progress is on track, and the terminal could start operations by late this year, 2022 already. By resolving this supply issue, FGEN dispels any doubts about its longevity. In fact, only a few years ago, people thought this company's out of business. But in fact, it has replaced its domestic source of natural gas with this from Tokyo Gas. Now, the next thing is that they are a pioneer in renewable energy and should be future-proof. We can see the installed capacity for the Philippines is mainly coal, then oil, then natural gas, and renewables is coming up there for sure. For now, the Philippines government still has a high tolerance for coal-fired energy generation. Cheap coal is likely to remain the dominant source in the near term. However, the government rewards the usage of renewable sources through long-term contracts with favorable prices. Philippine energy companies are required to start green transition soon. Now, in the Philippines, you can see from this table that I'm showing about coal, oil, and natural gas and renewables, almost 30% of installed capacity now in the Philippines is renewables. So that's a pretty impressive number there. Now, installed capacity of FGEN is now 58% natural gas and 42% renewables, as we saw hydro and other types. It makes up 20% of the country's total renewable energy capacity. The company runs indigenous renewable sources like geothermal, wind, and solar, and that's giving them almost 42% of revenue. Its early shift towards renewable energy gives the company a timing advantage. Therefore, I expect a stable and strong gross margin over the next few years. So, number 3, understanding undemanding valuation could lead to a re-rating. Here, I'm looking at a price to book chart, and we can see a D-rating that went really from 2014 all the way down to 2018, when price to book went from about 1.8, 1.9 down to about 0.6. It's since then, it's kind of bounced around, but it really never got above 1 times price to book. And right now, it's at about 0.7 or so. The stock trades at more than 1 standard deviation below its historical average on price to book. And FGEN regularly has beaten analyst forecasts in the past. With the LNG terminal, FGEN does not only solve supply issues, but might also sell excess LNG, creating additional revenue. So you're buying this stock pretty darn cheap, considering the opportunities that they have. Now, next, there's interest of institutional investors that could provide support. In 2020, the US-based investment firm KKR acquired a 12.6% stake in FGEN. KKR is a leading investment firm with total assets under management of $459 billion. In October 2021, KKR announced to acquire another 7% stake for Philippine pesos, 33 pesos per share, which is a 20% premium to the market. What do they see? I consider the follow-on investment of KKR as a positive signal that the share price could provide further upside. In other words, once they took the 12.6% stake, they got to understand the company well, and then they were comfortable enough to take this 7.3% stake in addition and bring that on. Now, KKR is the type of company that does at times take companies private, so it is possible that they take it off the stock market, but I would doubt it right now in the Philippines, but we'll see what they do with it. But I would say that this provides some upside from my perspective. Now, remember, you can scan the QR code to go to the valuationmasterclass.com blog to download all full case study reports for free. Just go to the link in the show notes if you are listening. Let's review the FVMR scorecard. It measures the stock's attractiveness relative to all other companies, and attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And the scale is number 1, best, to number 10, worst. So looking at the company, generally the thing is there's weak momentum, and that momentum that's weak is mainly in price. In fact, earnings momentum has been reasonably high, but price momentum has been weak. But let's look at valuation in a little bit more detail. The company is cheap relative to its competitors. We can see that the PE is roughly 7 times. Price to book is about 0.9, and it's got a PEG ratio. Well, let's just say for December, it was about 9 times. PEG's a little bit difficult when you've got a lot of volatility. Now, recently, I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan the QR code or go to the show notes if you're listening. Forecast. Well, analysts see strong upside. There's 6 analysts, and they've got a 28% upside in their target price. Almost all analysts have a buy recommendation, with only 1 analyst as a hold. Consensus expects solid revenue growth for the future, given the growing demand for energy. Also, margins are expected to stay stable at a high level, meaning that analysts are positive about the LNG substitution. So the net margin of this company has really been fantastic at about 12 to 15%. And that's pretty impressive. In the profit and loss, FGEN has delivered remarkably stable profits, and there's no reason to assume differently in the future. And the long-term takeoff or off-take agreement ensures stable margins. The country needs energy. And currently, there are no concrete expansion plans in place. So I believe that FGEN might add a few smaller renewable energy projects over time, but I don't see big CapEx coming for this company. Also, liabilities. Its strong cash flow generation allows FGEN to reduce its debt over time and fund CapEx internally. FGEN paid out a stable dividend payout ratio of about 12.5%. They're keeping it low, right? But that delivers a 3% dividend yield. Imagine if they started to increase the amount that they're paying out. There is potential to pay out more, and it could turn into a dividend play over the next few years. So that's also what KKR could get out of it, is dividends, but they're likely to invest in it for the purposes of expanding the business. So they may even come back and pull back on the amount of dividends, but really at 12.5% dividend payout ratio, it's not much. Strong margins translate into a good return on assets of about 5%. Now, if you want to learn how to value companies like this, check out my 6-week online valuation masterclass boot camp. The class starts on March 7th. It's practical knowledge that you're going to gain. It's focused on the tricks and tips and tools that I've used. It's inspiring because we've got amazing young people in it that are learning, and you get to tap into my network of financial professionals to try to get that job. You can save $402 until February 28th. Just scan this QR code and register, or just go to valuationmasterclass.com/bootcamp. So let's talk about valuation. Here, we're going to review the A Stotts Investment Research Stock Picking Checklist. It's inspired by Peter Lynch's book, One Up on Wall Street. When he talked about 10 baggers, that means stocks that go up 10 times. We did extensive research on 10 baggers, and what did we find? Well, we found that 9 factors drive long-term share price performance. So let's review them. First factor is management, that they have a commitment to growth. That is weak because they've had flat revenue in the past, as FGEN did not add much further capacity over time. Number 2 is growth. Can it grow at double digits? Moderate. Demand for energy might grow in line with population growth. Number 3 is margin. Does it have a high gross margin? It's good. 90% of its energy generation is covered by long-term contracts, ensuring stable profits. Number 4, predictability. Minimum non-core expenses. That's good. Non-core expense items are relatively small. Number 5 is intensity, that sales grow faster than assets. That's weak. It's a heavy amount of investments required to grow. Asset turnover is pretty low at 33%. Number 6 is conversion. Low cash conversion cycle is what we're looking for. This is moderate. Cash conversion cycle is moderate and stood at 24 days as of 2020. Number 7, cash flow, that they're consistently positive. This is where it's good, consistent and strong cash flows. We're able to cover the investing outflows. Number 8 is access to capital. This is moderate. Leverage is moderate. Net debt to equity stood at about 0.4. So I would say it's moderate to good. Valuation is reasonable. Trades below or lower on both PE and price to book than Philippine telecoms or other types of companies, utility companies, but it has a higher ROE. So altogether, I would say, what is the 10-bagger potential for this company? Nah, it's pretty low. I would say maybe 2 times it could go up in the next few years, but definitely not 10 times. So let's look at the free cash flow. Remember, of course, just because a stock isn't a 10-bagger doesn't mean it's not attractive. There's a lot of benefit to having a very stable and strong company providing dividend, all that. FGEN cash flows on a consistent basis, and the market might not have yet appreciated this fact. So let's look at the value estimate. Right now, my short-term outlook is roughly in line with consensus. I'm a bit more optimistic on the long-term future and to believe that the company can maintain a great ROIC of about 10 to 12%. The company's WACC is about 9%, so they are creating value. The cost of equity I use is about 11%. So if the ROIC is consistently above the WACC, then this company theory, should be trading at a premium price to book. If we look at the free cash flow to the firm method, I come out with an upside of 40%, a bull case of 54, and a bear case of 27. Let's look at the world-class benchmarking scorecard of this company, where we identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth, and the scale is from 1 best to 10 worst. Here we can see is that when we benchmark the company against 320 large utility companies worldwide, we can see that it is ranked at a 3. So it's definitely above average over the past 12 months as well as the past 2 years. Not bad performance. Profitability is also ranked. That profitability in this case is ROA, and it is ranked at a 3. So definitely above average there. And growth is average when compared to 320 large utility companies worldwide. What are the risks? Well, the key risk is delay in resolving the gas supply. Delay in building the LNG terminal could disrupt its gas production. Unexpected outages of production, weather conditions, transmission constraints, that type of thing is another risk, and high dependency on Meralco, which makes up 50% of its revenue. So conclusions are FGEN is to remain a cash flow machine as supply problem seems to be resolved. The early shift to green energy is pretty much great timing for this company. They're ahead, and it is a coal-dominated country in the Philippines. Valuation is cheap. Institutional interest could unlock upside. So my question to you is FGEN an overlooked power play that deserves a re-rating? What do you think? Let me know your thoughts and ideas in the